Welcome to this session. So, I'd like us to go through something on the battlefield. The battlefield, okay? Now, the reason why we're going to talk about the battlefield is because at this point where we have reached Mali tumefika saizi, I believe you understand how most retail traders trade. The retail, I believe you understand the retail, how most of them trade. Now, one thing I want to understand is you're not trading the charts. Wakati una trade, you're not trading the charts. You are competing against big financial institutions, and most traders are completely unprepared. BFIs, and most of them are completely unprepared. So, the primary objective of this lesson for today is that you as a student you're supposed to understand the true power structure of the forex market, who the BFIs are, how they operate, and why conventional SMC fails retail traders at the point of execution. Okay. Now, the BFI is a framework. You need to understand why the market is not random and that it is engineered by institutional players with specific agendas retail traders unknowingly serve. As a beginner, you're supposed to strip away every assumption. What you are taught about the smart money is only half the picture. So BFIs, who are the BFIs? The big financial institutions. The BFIs, the BFIs are the BFIs are institutional players. We have tier one and tier two institutional players like the central banks, prime brokers, investment banks, and large hedge funds. So they do not trade like retail. They do not trade like the traders. And their main task or their main work is to engineer price to find liquidity. So they engineer price to find liquidity when they need to fill orders worth hundreds of millions. And their stop loss is not a collateral damage, it is their fuel. Okay. According to the TWR liquidity system, it is built entirely around understanding and anticipating the BFI's behaviors, not copying it. This system is built around understanding and anticipating the big financial institutions and the big BFI's behaviors and not copying it. So let's take an example of a bank. Okay, so a single BFI order can exceed the entire daily retail volume. They cannot fill at one price. They need price to travel through a zone to accommodate or a zone to accumulate their positions. Let's say that a bank want to buy 500 million units. Institution needs to buy 500 million units. To buy 500 million units, institutions need to sell. Yani, institution need 500 units of sell orders. The engineer price to where retail sellers are clustered, then absorbed. Now, for a trade to occur, for me to buy, another person has to sell. Okay? For me to buy, another person has to sell. That is the first thing that we have to agree on. Okay? For me to buy, another person has to sell. Now, for a bank, for a trade to occur, if a bank wants to buy like 500 million units, if a bank wants to buy like 500 million units, it means that it needs another person to sell these 500 million units to them. Okay, so you find that the engineer, they cannot just press buy or sell immediately at the current price saizi wakiamua kubai ama kusell at tuseme mali price ziko, what price is trading at currently, it will cause things like slippage, ama price itapanda tu immediately, itapanda tu na mbio, and this one is not favorable for them. They'll buy at worst prices. Now, just a moment as you fix something here. Okay, nice. Let's continue. So there is something that I want you to understand right here. There's something that I want you to get. Okay. There's something that I want you to get. Where is it? So hapa hivi tumesema kama institutions wanataka kubuy, they'll need another person to take the sell. And who is going to take the sell? The retail traders. So big institutions need retail traders orders to fill their massive trades. Hiyo ni kitu ya kwanza that we have to agree on. Okay, they need retail traders orders to fill their massive trades. That is the all foundation. Hii hapa ukielewa tu hii hapa what chenye nasema hapa saizi. Okay, big financial institutions need retail traders orders to fill their own massive trades. That's the whole foundation. Everything else comes from this idea. Okay, every trade needs a buyer and a seller. If I want to buy Euro USD, someone else must sell it to me, no exception. Okay, now imagine a huge bank want to buy 500 million Euro USD orders. Okay, this is massive. The problem is that there may not be enough sellers available immediately. So if the bank just presses a buy instantly, price shoots upwards fast. Ikipress to buy, ukikuja kwa platform yako utaona buy na sell. That is the only thing you can do. Sa bank hizi finya to buy it immediately, price will shoot upwards fast, and before they finish buying, price itapanda tu, and they end up buying at worse and worse prices, and this is bad for them. Okay, so what do they need? They need lots of sell orders sitting in one place. Hii sasa ni retail. Ndio hapa hivi retail. So the retail role, retail traders are liquidity providers, not market participants. Every predictable stop loss placement is a potential institutional fill. So hiyo ndo nilikuwa na explain hapa hivi saizi, that they need lots and lots of orders sitting in one place. Where do they find them? Where do they find these retail orders? So retail traders especially, mali watapata kwa stop losses, especially on stop losses where breakout traders place and where they place pending orders, because retail traders place orders in predictable places. Ndio hapa every stop placement is a potential institutional fill. Okay, I hope up to there we are together. So a stop loss is not magic. A stop loss, one thing I want you to understand about a stop loss is this. A stop loss is not magic. A stop loss is simply an order waiting in the market. If you buy and place your stop loss below a low, when price hits your stop loss, you are Your trade closes by selling. Okay. Now let us understand this. For who are the BFIs? Tumesema BFIs are the big institutional players like the central banks, the prime brokers, the investment banks, and large hedge funds. Okay. And usually they do not trade like retail traders. Why? They usually engineer price to find liquidity, and they need liquidity that they need to fill their orders, and their orders are big, like orders worth 500, orders worth hundreds of millions. So a stop loss is not a collateral damage; it is their fuel. We've said this about stop losses. A stop loss is not magic. A stop loss is not magic. A stop loss is simply an order waiting in the market. Tukapatiana example ya kwamba when you buy and place your stop loss below a low, when price hits your stop loss, your trade closes by selling. So your stop loss becomes a sell order. Okay. Now the role of retail traders. First thing you have to understand about retail traders is that they have predictable stop loss placement. How they trade is just predictable. Now, for if an institution wants to buy like 500 million shares of 500 million units of Euro USD, they'll have to find 500 million units of orders, and they just can't press a buy or a sell immediately. Why? Because of liquidity problems. Okay. Now, let us continue. Let us continue. Why do you think BFIs? Why do you think BFIs and stop losses? Why do you think BFIs and stop losses? Number one is that imagine a bank wants to buy heavily. What do they need? They need sell orders. And where are many sell orders sitting? Below lows. Below lows. Okay. Let's say this one was so if they're buying, retail traders will look to buy here. Their stop losses are sitting below these lows. So they need sell orders. Na tumesema hapa mali stop losses zao ziko. A stop loss is basically an order. So kama umebuy, stop loss yako itakuwa sell. Okay? If you buy, your stop loss will be a sell. And where are many orders sitting? Below the lows. Okay? Why? Because that is where retail traders place stop losses. So what do price do? Price moves to these. Price comes to these stop losses, and hapa hivi juu most retail traders wameingia buys, they look to wanaweka stop loss zao hapa chini, and then wanakuwa taken out. So watasema price imeni stop out, imeni stop hunt, I just got stop hunted. But according to a framework, the bank pushes price there because the bank pushes price to this point because they need sell orders to fill their buys. Imagine that 10,000 traders bought Euro USD at this point. Alafu wakaeka stop losses zao hapa chini. Wakaeka stop losses zao hapo chini. So price drops to that low and the stop losses are triggered at once. Okay. So the bank happily buys all of them. So hapa hivi ndio sell orders zinatokea. Hapa ndo sasa bank ina buy from. And now the bank can now move the sasa ndo sasa price inaweza endelea sasa kupanda. Okay? Then price rises. So this is the core idea. This is the core idea. The market is not only moving. The market is not only moving because of patterns. Okay? Price moves where orders are sitting. Hiyo ni kitu ya kwanza we have to understand. Price moves where orders are sitting. Price moves where orders are sitting. Now, kuna kitu nataka uelewe. Mali umeona a supply or a demand zone, according to traders, retail traders or smart money traders, that is their buy, that is their entry point. But according to us, that one is a trap or an inducement. Okay. where order blocks rest. Order blocks ni same na supply na demand. Okay? Where they rest, sisi tunajua that is where retail that is where retail is waiting. Okay? Mali unaona break of structure, mali ya watu wataona kama break of structure. Break of structure after a trap. That one is free. Yani hiyo ni kama ina build more liquidity. Mali unaona fair value gap imekuwa filled. Fair value gap ama imbalance. Au sasa wanaona ni high probability ya take long ama short. But sasa sisi tunaona fair value gap exist where trap mitigation. Yani fair value gap exists but trap mitigation are invalid. So any demand or supply to us, it's a trap, an inducement. Okay. Why smart money zones are a trap and not entries? This is where core insights. This is a core insight for the entire TWR system. It takes courage to accept it. Okay. Anyway, mali umeona every SMC demand and supply is visible. Kila mtu anaona, visible to tens of thousands of traders globally. They all place entries and stops at the same level. This makes those zones the most predictable liquidity pool on the chart. And the big financial institutions not this. They engineer price to move. They engineered the move. They engineered the move that created that zone in the first place. They will return to it, not to fill your order, but to use your stop as their entry fuel before driving price to the opposite direction. So that is the first thing I want you to understand. Why? In the reason mbona smart money failed. Smart money was actually working a while ago, but this is the reason why it is failing. Okay, this is the reason why it is currently failing. Number one, tumeona the mechanics. Price approaches demand zone. So let's say this one is our price. Imekuja ika break structure. This is our demand. Let me change the name. Now, according to them, according to the smart money, price approaches demand. Price approaches this demand. Retail traders look to long because they saw that price broke a structure. After price may break structure hapo hivyo, this is where now they look to take buys from this position, from this demand. Okay, so when they enter longs, their stop losses are placed below this area. Okay, and stops are placed below the zone. So you'll find that what the big financial institutions do is that they push price to trigger all the retail stop losses, and these na tumesema easy stop losses, when they buy, these one are sell orders. These are sell orders. So these provide a sell side liquidity. Then after all stop losses have been taken out, sasa the real move sasa inakuja. Then price reverses upwards. Also, you find that there are some fake reactions. Most of the time, price does react from the zones. Price imekuja kwa hii demand zone. Okay. These triggers early long trades and give SMC traders a confirmation. Then price continues lower to take out their stop losses. So once imetag, tutapata this one right here is a fake reaction. Okay. So alafu kuna kitu inaitwa the fake break of structure trap. Fake break of structure trap. What is a fake break of structure trap? Utapata after the trap reaction, SMC traders wait for a fake break of structure or an FBOS as a confirmation. So according to us, this FBOS is the confirmation, but we take the trade in the opposite direction. Okay. So the result is that smart money traders lose consistently, but not because the concept is wrong, but because they are trading exactly where BFIs need them to be. They are moving predictably, ni kama puppets, okay? It's like they are being controlled. So we have we have important terminologies that we have to understand. Learn these terms precisely. These are not interchangeably, but with SMC terminologies, okay? So ya kwanza tuko na BFIs. BFIs tumesema ni the big financial institutions. The institutional players engineer the institutional players who engineer price movements, like the central banks, the big financial brokers, the investment banks. They operate with size that create liquidity demands. Number two, tumeongelelea. Number two, when we are talking about SMCs, kina structural highs, structural lows, kuna kitu I mentioned about relevant liquidity. Relevant liquidity, this is the last point where price took out a structural point from an H1 logic, and the BFIs are in drawdown from this point, okay? And the price needs to revisit that level. Let's take up an example of this move in H1. This one is a H1 time frame, 1 hour time frame. So according to us, this one now will be the H1 relevant liquidity. H1 relevant liquidity. Juu hapa hivi most of sales zina rest. Hapa stop losses mingi zina rest. So the last point where price took out a structural point from an H1 logic. So tunaona this is the last point. This one was the structural point, okay? Price ikakuja ikai-take out, and so saizi wako they are in drawdown. Then sasa kuna H1 trap ama smart money trap. So we say that this demand area hapo hivyo ndo sasa ni trap yetu. This one is our traps, okay? Hii ndo trap area. What SMC call demand, mali SMCs wataita demand, sisi tunaita trap. What SMCs call demand and supply, in TWR, this is inducement, and a zone everyone trades from, and BFIs use it to collect liquidity. So this one is our trap. So mali umeona H1 trap, hiyo tunajua ni trap ama smart money trap, okay? Smart money traders trap, SMT trap. Then tuko na kitu inaitwa fake break of structure ama FBOS. A fake break of structure ama FBOS. Okay, just a moment. A fake break of structure ama FBOS. So what SMC traders call a confirmation entry after a break, according to us, that one is a signal to trade to the opposite direction. So utapata price ikikuja kwa this one, then this one should be full screen. Okay, let us just continue. I was explaining something about a fake break. Na tukasema itu ni confirmation, a more confirmed entry, okay? Then relevant liquidity taken. So the prerequisite condition for any trade is that no entry model is valid until a relevant liquidity has been swept. Without this, no trade. Understand this, that before you take any trade, hakikisha ya kwamba we have had a relevant liquidity has been collected. Then sasa tuko na inducement. Price action specifically designed to attract orders like traps, fake reaction, fake break, all forms of inducement build institutional order flows. Then every smart money, every SMC order block you see, every demand you mark, thousands of other traders see the same thing. That predictably is not an edge, it is a trap. And the BFIs build that level knowing exactly who will show up. So they'll print for you something like this. They'll engineer price to show something like this. Breakout wameingia. Smart money wamekujiwa. Price may come to this area. This one, according to smart money, is a demand. Every demand you mark, thousands of other traders also see the same thing. And that predictability is not an edge. That one is a trap. Alafu sasa hapo ndo sasa stop losses zina rest. Wanakuja wanatolewa, then sasa inaenda their way. Okay? So let us get into who are the BFIs. We've understood who the BFIs are and how they operate. Okay. Then now look at this. Kuna kitu inaitwa drawdown pool, drawdown logic. Okay, we've also understood SMC and TWR logic, side by side comparison, where tunakuja najua saizi you understand SMC, how SMCs work. Kina break of structure, demand zone, pull back to the demand zone, where they place their stop losses, and we dismantle each concept and build it with the new BFI's perspective. We've also identified traps okay. What you expected to do ni kwamba find examples where price gave a reaction from an SMC zone, creating an fake break, and it reversed from it, taking the stops. So hii hapa I want you to go to the charts. Zile areas tulikuwa tuna mark kama SMC demand, that one is now our trap. Wait for price to come to that area, then iwapatie fake reaction, then it goes our way. It goes now the anticipated way. Alafu sasa I want to talk about the BFI's logic, the BFI's drawdown logic. Okay. Now, I want you to understand this. Okay, hiyo ni kama sioni. Now, wakati BFIs, if BFIs are in drawdown, price will return to their levels. So, you as a student, you have to learn to identify relevant liquidity and understand why those levels act as magnets. So, price often revisits the areas where banks originally built position. Why? Because they may still need to add positions, reduce positions, distribute positions. So the area acts like a magnet. Mali unaona kuna relevant liquidity. Let me use a pen. So uelewe hapo hivyo vizuri. Mali unaona kuna, take an example of a buy. We've had the break of structure. So kila mtu will be looking to buy. Everyone will be looking to buy. Okay. Because everyone will be looking to buy, retail traders are taking buy positions. Who is taking the opposite of their buy position? Ni banks. If everyone is buying, kuna watu wameona hii breakout, kuna watu wameona hii break and retest, kuna watu wameona hii trend line, something like this trend line. Everyone is buying, so everyone is looking to buy. Na price pay na buy. What happens? When price is buying, everyone is buying. What happens is that who is taking the opposite of their positions? Juu tumesema for a trade to occur, for a buy position to take, for you to buy, you have to have a sell. So he's taking the sell position. The BFIs ndo amechukua sell. So kama BFIs wana sell, alafu retail traders wana buy, inamaanisha BFIs they're in drawdown. What do drawdown means? Inamaanisha they're in losses. Okay, so price lazima irudi hapa mali walianza kuplace hizo orders zao. So this one is our relevant liquidity. Kama mali stop losses in a rest. So this one acts like a magnet. Hii ni kama magnet. So price ikirudi to these areas, it will come to reduce. Watakuja maybe wanataka kuongeza positions, they want to add ama wanataka kupunguza juu they're in drawdown. So that is the meaning of drawdown logic. Then common mistakes and hard rules that we have to understand. Treating SMC zones as valid entry points. Tumesema according to our system, the TWR system, SMC demands and supply are traps. They are inducement. If you enter from them, you're providing liquidity to the institutions and you're not competing with them. Something else. Kuna kitu fake break. Fake break, these guys SMCs uses as a confirmation to enter. But they use it as a confirmation. But according to us, it's our signal to trade the opposite direction. So the break is fake. and it is designed to pull more orders. Okay. Something else is that thinking that the initial zone reaction means that the zone is valid. Seme price ime break structure. This one is our demand. This one is the SMC demand. Price ime pull back to that area. Ikaanza kupatiana initial reaction. Ikaanza kupatiana some buys. So price reacts from a trap regularly. But this one is an inducement. A reaction is designed to attract more entries. And the real move comes after those entries are stopped out. So ikianza kupatiana this one is a fake reaction. Okay. Ikuje iwatoe ndo sasa ipatiane now the real reaction. Next thing is that skipping the relevant liquidity prerequisite. So don't take any positions. No entry model works without a relevant liquidity being taken first. This is the add gate. Skipping it is the single most common reason why students take invalid setup. So hii ndo relevant liquidity mali ina rest. Ngoja ichukuliwe kwanza ndipo sasa uingie the buys. Okay. The assignment. I believe up to this point you understand most of what I'm talking about. So if you have a question below where I'll post this video, hapo chini, you can ask your question. Just type your question hapo chini, we'll answer them. The assignment. Go to the GBP USD chart on the H1 where price reacted from an SMC zone, formed a fake break, then reversed and took out stop losses behind them. Nataka ufanye, let me see. This is the reaction yenye nataka ufanye. Okay, hii ndo assignment nataka ufanye. Go to your charts, utafute mali price ilienda ikareact from a demand zone. Then from hapo hivyo mali price ilireact from a demand zone, notice it. Saizi I know you know how to identify SMC's demand zones. Notice it. Nataka label, nataka uende ufanye kitu ya itafute kwa chart, then you send them to me. Write one page of how. I don't think this is really viable for you, Jeni. You are not really using SMC kitambo, but how my understanding of SMC changed today. So what have you understood about SMCs? Tumeona ya kwamba mali SMCs, where SMCs look to buy, SMCs look to buy from a demand zone, right? So according to us, that demand zone is a trap. That demand zone is a trap.
Take a look.
Ooh,
Hey,
that one
take a
is
look.
my damn.
Hey, take a look.
That one is my alert.
Take a look.
That one is my alert. I'm in the charts currently. That one is my alert. Imekuwa triggered, so I'll watch and see what price does. But let us just continue. Mark out the visible H1 relevant liquidity on H1 and H4 over the 30 days. Track 5 sessions each day, visible SMC zone, predict trap areas. So these two tutaifanya pamoja, but this one I want you to do this and this. Okay, then at this point I need you to, nataka nione umeelewa this BFI is drawdown. Explain why SMC demand is a trap. Alafu we've talked about fake breaks and what must happen before any trade model can be considered. Then on a chart, identify relevant liquidities and trap areas. So yeah, this is what I want you to do. Let me see if I can get an example. Let me see if naweza pata example. Let me see if we can get an example. Let me see. Can you get an example? Not there. Let us see. So kama uko na swali lolote, if you have any question, just type it down, ama you can ask me. Unaweza niuliza. Fake break. Let me see you. Where is it? Where is it? Yeah, right there. So let us tuone kama tutaipata hapa hivi kwa hii Notion. Hapa hivi kwa hii Notion. So just come to the setups. Alafu tunakuja hapa hivi. Now take a look at this. Take a look at this. Tunasema once SMC wameonanga hii kama break of structure, they look to trade from here. Okay, they look to trade from here. Price ikawapatia hii confirmation wanataka kuingia. Stop losses out the rest hapa. Now this one is our relevant liquidity. Then ndo sasa the real move. And in the chart, this is how it played out. SMCs waliona hii kama demand zone yao. They are looking to trade from this point. Okay, price ikakuja hapa ikawapatia reaction. Now sisi sasa tuna trade after this. Unaona this one ndio ilikuwa relevant liquidity. Now you can look to buy from these areas. So this is an example. Now I want you to go to the charts and find more of them, more of these ones. Okay, yeah, so up to there I think I'll stop the lesson from there. Yeah.